Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, August 12th, 2020, and I am pre-recording this Trading Places Live for Thursday, August 13th. Futures currently are flat after hours. We have had a couple of reports, though, earnings reports. We'll talk about that later. Cisco's out after the bell. Market not exactly responding favorably to that report. But again, we'll talk about that in just a bit. Our agenda for today, we're going to start off with that daily market recap, move into talking technically. We got a little bit of a lift from growth stocks on Wednesday, and as a result, I think things started to flip again back toward the NASDAQ's favor. We'll see whether or not we can continue that on Thursday, but at least we got off to a good start in that regard. Then I'm going to get into something that might surprise you, maybe it won't, but I've got an S&P 500 prediction to make, and it's kind of a wild one. A lot of people might think it's crazy. I think it's going to be hit, and I'll talk about that. Then we'll get into the earnings spotlight and wrap up the show with 3 you must see. But before we get into any of that, I want to just take you over to earningsbeats.com. For any of you that are new to Earnings Beats, love to have you join us and join our community. We have a free Earnings Beats Digest newsletter. It does come out on Mondays, Wednesdays, and Fridays, usually before the market opens. If you sign up, just put in your name, email address, hit that subscribe button. You can unsubscribe at any time. No credit card required. If you want to join, you want to try our service, we do have a no-cost 30-day trial. $7 when you sign up, but we will refund you the $7 within a week. And you can sign up by clicking on this Join Today button. That'll take you over to a page. Gives you a little bit of information about some of the things you'll get. You can try us for 30 days, see what you think. Going back to this, though, you can see that our model portfolio, this was as of Tuesday's close. I know on Wednesday we had a really good day with the model portfolio. But Tuesday we were up 108.91% since our inception back in November of 2018. During that same period, the S&P 500 was up only 23%, almost 24%. So you can see the outperformance pretty significant. This quarter, the model portfolio is up more than 10%. And again, that's before Wednesday's results. Wednesday, we had a really strong day in our model portfolio. So the numbers later will actually be updated, and you'll see even more impressive performance. I mention all this because we update our portfolios. We reselect, have what I call the draft, where we put 10 equal weighted stocks from 10 leading industry groups into each of our portfolios that we hold for 90 days. So it's great for those of you who maybe work and want to be in areas of the market that have been leading and are outperforming the S&P 500, but you don't want to spend the time at your computer all day, or maybe you just simply don't have the time to spend. Our portfolio, or our members who use the portfolios many times are members that simply can't, don't have the time to trade, or simply don't want to trade. So it's just another part of our service for those of you who want to benefit from relative strength, solid earnings, and so forth, but don't have a plan to do so. We have that for you. All right, let's go ahead and jump into the action from Wednesday. The Dow Jones Industrial Average up another 1%, 290 points, getting close to 28,000, right on the edge of 28,000. Our all-time high is a little above 29,000, so we still got a little work to do there. But the S&P 500 is getting close. 3393 and change, I believe, is the all-time high and the 52-week high. We closed at 3380 on Wednesday, so we're only about 13 points. It's less than 0.5% away now. It's just a matter of time before we make that breakout, in my opinion. NASDAQ led the action again. That's what I was referring to at the open. NASDAQ up 229 points, more than 2%. Right back off of that 20-day test. Beautiful bounce. That's where the NASDAQ's been bouncing for a while, and it did it again. Mid caps up about 2/3 of 1%. Small caps up about 1/2 of 1%. So all of our major indices higher. Technology back on the top of the leaderboard. Healthcare, which has been missing from the leaderboard for quite a while, actually broke out to a new closing high. Can't really see it on this chart, but we did have a new closing all-time high on the XLV. Utilities made a move up, gained 1.45% on Wednesday. Still trying to make this breakout above the June high. Not quite there yet. Discretionary adding to its record highs and record closes, up another $1.88 or 1.3% on Wednesday. And then financials, the only sector to lose ground. After leading for the past several days, financials definitely took a break. We saw a little bit of profit taking in that area. We did see the 10-year Treasury yield, which I'll talk about in just a second, back off of its earlier high. And I think that's why we saw some profit taking in the financial area. But I still believe that group, along with all of the areas, goes higher. And I'll get into those predictions that I have, or that major prediction on the S&P 500 in just a few minutes. 10-year Treasury yield. Actually, from the last I had looked at it, it was back down to about 0.66. Finished at 0.67. So we did finish up for the day, but you can see off of that earlier high, 0.69, down 2 basis points from there. So I think that was definitely impacting the financial space, and I think that's why we saw a little bit of a pullback there. As far as economic reports on Thursday morning, we will get the initial jobless claims. Right now, the market is expecting 1.15 million. Last week's totaled 1.19 million, so the market's expecting a little bit of a drop there. Coming up on Friday, the headline economic reports would be retail sales, industrial production, and consumer sentiment. So we do have a pretty busy schedule, economic schedule at the end of the week. All right, it is time to move on to talking technically. And here I want to bring up the IWF IWD. And this is a chart that I showed on or in our daily market report to members. I think I also showed it in one of my shows, not sure which one. But one of the things I'm following is the IWF IWD, which is growth versus value. It's also a lot of times tied to our strong AD chart list versus our weak AD chart list. Weak AD chart list is made up of a lot of the value stocks. Strong AD chart list made up a lot of the growth stocks. And so we could be looking at our chart lists, comparing them. We could look at the IWF versus the IWD. We also, as I pointed out, could look at the NASDAQ 100 relative to the Dow. And if you look at this, you're going to see pretty much the same chart. I mean, it looks almost the same. So again, we go back to the other, but we held, see this triple bottom? And I would even say that this prior high back in mid-May, we went back and tested that. We got a breakout, went back and tested it. I even think this triple bottom, you could go down to that low there. And that's the same on this IWF, IWD chart as well. I'd be looking at these various lows and that prior high, which was at 1.68. Notice the low here, 1.68. I think if we break below that, maybe it's just a head fake, but if we break below that, you have to at least be open to the possibility that maybe August is going to be a little rougher on the growth stocks. But today's action, we did see that move back up above that falling 20-period EMA, 20-hour EMA. That could be the sign. Many times when we're falling below it, we come back up above it. That starts a big move to the upside. So it's possible. But there have also been times, you saw this at the end of May, early June, where we had a move up, looked like we were reversing this downtrend, and then we fell one more time. So I'm not quite sure where we go, but if we do fall, if you see tomorrow, value leading again, I would be watching maybe this 1.68 level. And if we do go below, I definitely would want to see a very quick turnaround back to the upside. So those are just a couple of things maybe to keep in mind. A couple areas broke out. I mentioned healthcare did very well on Wednesday. And you can see right here, we closed at 107.15, taking out these prior high closes. Now we're still clearly above where we were in January and February. We got that breakout about a month ago. And after sideways consolidating for the last 3 or 4 weeks, it looks like XLV could be ready to go again. I like the volume coming in today to accompany this breakout. I think the XLV goes higher. Another group that broke out today, and this is a group that really hasn't done nearly as well, I think, over time. You can see we're just now getting above that February high, so not quite as good as what we saw in the technology area and consumer discretionary and communication services or even healthcare. But, breakout's a breakout. And in a secular bull market, wide participation is one of the characteristics. It's not like in a major bull market advance, just 3 groups go up. Everything, for the most part, goes up. It's just which goes up faster. And that's what we're most concerned about, especially when we're looking to trade or when we're looking at designing our portfolios. We're looking for relative strength. That's going to be technology. That's going to be communication services, consumer discretionary, not necessarily consumer staples. But again, a breakout is a breakout. Very important to see these moves to the upside be sustainable by seeing more and more groups breaking out and confirming this secular bull market advance. And I think we're seeing that. All right. So how impressive is this secular bull market going to be? I'm on record a year ago talking about the S&P 500, maybe not quite a year ago. Or actually, I think it was sometime last year before the end of the year. I said that in 2020, the S&P 500 would hit 4,000. And a lot of people thought I was nuts. I definitely believe if we didn't have the pandemic, we probably would have already been there. I mean, with the pandemic, the S&P is trying to set an all-time high. Without it, I think we'd have already been to 4,000. But if not now, by the end of the year. And I still think by the end of the year, we might get there. I look for a very, very strong fourth quarter. I think there are some headwinds. You know, we've got the vaccine, the virus, you know, still a little uncertainty there. We've got the election coming up. Definitely going to be some uncertainty there. So there are reasons that maybe the market kind of hesitates or even has a pullback at some point. But I believe once we get all of this behind us, I really look for the market to scream higher into the end of the year. So based on all this, where do I think the stock market can go? Not just 2020, 2021, but where do I think it could go 10 years from now? You might be a little surprised, maybe not. You know, I'm bullish. If you follow me at all, I'm extremely bullish. I've got to be one of the most bullish people out there. And I really fall back a lot on this long-term chart. And I bring it up a lot, but I also have a lot of people that are listening to me from time to time that are new. And this bears repeating. And I think everyone should be focusing on this chart. It's not unusual for us to go into secular bear markets, 12, 13 years where we go nowhere. We set a top 2000, couldn't get through it in 2007. And we didn't break that 2000 high definitively, like convincingly, until 2013, 13 years later. If you go back and you look at the top here, very similar. We did go up, you know, if you start the secular bear market in 1968, we did actually go slightly higher in 1972, but didn't last very long and certainly was not definitive as we went down and put in a new low. And then it wasn't until in the 1980s before we took out these highs that were printed earlier in the 70s and in the late 60s. Again, 12, 13 years before we finally convincingly broke out. Go all the way back here, double top in the 30s and 40s. That from 37 all the way to 50, 13 years, finally made the breakout. But here's the deal. When you break out, and there's a lot of reasons, but when you look at these secular bear markets, look at the average return during the 70s, 2.8%. Average return of the S&P 500, 2000 to 2013 was 1.55%. I mean, consider what our GDP was during those many years. Consider what inflation was. These returns were way too low. So you go into these secular bull markets and you play catch up. And you think, well, man, if I could just have a 5, 8% return, that would be great. During secular bull markets, you're going to have more than that, because when you average up secular bull markets and secular bear markets, you're probably looking at an average return of 8 to 9%. So when you go through these bear markets, secular bear markets, you don't really earn much. When you go through secular bull markets, you earn a lot more. So in the 50s and 60s, we averaged 11.28%. In the 80s and 90s, we averaged 15.41%. And so far in this secular bull market, now remember, we just went through the trade war, the pandemic, so I think the number is a little lower than what it should have been because of that. But hey, if we had done this calculation at the end of 1987, we would not have been at 15%, I can promise you. From here to here would not have been that much. After the crash is when things started to pick up. I believe after this pandemic, I think we're picking up. I think we're going to go a lot higher. So right now our average is 8.75. Now I did a little calculation here, projecting if we go back and let's say that we earn 11 throughout the entire secular bull market. Let's just bear with me. Let's say we do go till 2030, 2033. 2033 would be 20 years, which would be very similar to the length of these last two. But let's just say through 2030. If we start with the S&P 500 where it is, or where it was on April 10th of 2013, that's when we made the breakout, by the way, April 10th, 2013. So if we go from that date and take the S&P 500 close, which was 1580, and we calculate the return to be 11.28% throughout this entire bull market. So I'm just saying that by the time this is said and done, the average return is the same as it was back in the 50s and 60s, 11.28%. Our S&P 500 at 1580 would be right around 10,000 at the end of 2030. If we earned 15.41%, as much as this secular bull market, I don't know that we'll do that, but if we did, an average of 15.41% would take that 1580 on the S&P 500, that breakout, to roughly 18,000. 18,000 by the end of this decade. So we've got the swing of either being 10,000 to 18,000 based on if we keep up with this secular bull market or if we keep up with this secular bull market. Now, if we go in the middle somewhere, let's say we average 13%. And by the way, that 8.75% is as of April 10th of 2020, right in the middle of the pandemic. So at that time, the S&P 500 was only 2789. Now the S&P 500 is near an all-time high at 3380. Okay, so this 8.75 was the calculation through April 10th. This number would be probably 10% or more. I don't know exactly what it would be. Maybe 10. I'm just going to guess 10%. Based on where we are today on the S&P 500. So don't look at this and say, well, why aren't we using 8.75? That was literally back right in the middle of the pandemic. Doesn't take into account this bounce that we've had since, most of the bounce. Anyhow, so think about that for a minute. I mean, I believe that there's a reason why we go through these secular bear markets, secular bull markets. And I think there's a lot of validity to it. I think that we're going to go much, much higher. And I think the acceleration is going to be greater. I think we're going to really be moving. I wouldn't be surprised. I think there's an outside chance that by the end of 2021, we could be up another 40% from where we are right now in less than a year and a half on the S&P 500. First of all, we've never had a period with interest rates this low. Never. And when we get past the virus and we return, we're already on the path to returning to strong economic growth. But when we get there, earnings are going to explode. They already have in many companies, Apple, Amazon, Tesla. I mean, these companies, the valuations are going up because they are growing their earnings so fast in a very, very low interest rate environment. Are you going to maybe take a chance and risk some money in Apple or Tesla, rather than put your money in a 10-year treasury yield getting 0.6869%? Apple's dividend yield is more than that. To me, it's not even a choice. And I think that's what people are going to realize. And that's what money managers are going to realize as money rotates out of treasuries and into equities over the next 10 years. That's going to be the fuel. So I'm going to go on record and say that by the end of this secular bull market, and I'm talking all the way to 2033, I believe the S&P 500 is going to approach 20,000. We're at 3,400 right now. And that's just taking an average of 13. That's taking an average of these two previous bull markets and assuming that it runs 20 years like both of those did. You might disagree with that. That's fine. But I can tell you this, back in March when everyone was panicking, this was March 13th, right in the middle of it. I wrote this article in Chart Watchers and said, I'm firmly in the camp of this being a cyclical bear market rather than a secular bear market. Cyclical bear market, meaning short term, that we were going to return to highs. And there were a lot of people that thought I was crazy back then. But where are we? The S&P is literally one day away maybe of 52-week and an all-time high. NASDAQ's already there, and the Dow's probably a month away. Market's going higher. So there you have it. Crazy prediction by Tom. All right, let's keep moving on. I want to go over some earnings reports. Let's move on to earnings spotlight. And I tell you, let's go over here and let's take a look after hours and see what Cisco is doing. Right now it's down 6.3%. Cisco beat their bottom line, 80 cents versus 74 cents, but it had moved to a high, taking out the June high. It's not been one of the best performers, though. If we pull up Cisco, and I'm going to bring this up on a relative chart. I mean, look at the relative weakness here in Cisco versus the S&P 500. It was at about a 6 or 7 month low heading into its earnings report. Wall Street wasn't expecting a whole lot. Now, the bottom line came in better than expected, but the market obviously isn't that impressed, down 6% after hours. So Cisco, I think we got to be a little careful of. Let's go to another one. Let's move to RPRX. After hours down, a little less than 0.5%, no big deal. We did, this was a fairly new company where we gapped up, or where we opened, not really a gap, but we opened with the IPO around 43, 44, moved down to 42. You can see recently we went just below that to 40 and now starting to trend back to the upside, but it looks like maybe we'll pause a little bit at least on the way back up. They did beat on their bottom line 73 cents versus 61 cents. Next up, reporting after hours tonight, Wheaton Precious Metals, WPM. They were, last time I looked, they were up 1.4% in after hours. So it's not showing anything here. So we are up a little bit. I think as long as the stock holds on to about 47 and a half, watch that rising 50-day moving average. But I think that we've got a good chance to bounce if we get down that low. All right, next up, ZTO. This is ZTO Express. Stock down 5% after hours. This is one that just continues to consolidate. I mean, 35 and change. I think as long as we hold 34, we're okay here. The stock did miss, though. Came in at 26 cents versus 28 cents. So I've got a little bit of a problem there. If it breaks down after missing on its earnings, I'd be more careful. The last one that I wanted to talk about tonight that has reported is Lyft, LYFT. They actually reported a much smaller loss than expected. Wall Street was looking for a loss of $1.58. They came in with a loss of 86 cents. The stock still down 0.5% though. And you can see has not really budged much to the upside. And this is another one where if we pull up that relative strength, I think you're going to see that, you know, it's the software group. It's included in software. But as the software group goes up, not performing well versus software. But just look at it relative to the S&P 500. It's been moving lower. It's down near about a 4-month low, and it's not that far from a 52-week low. So I try to outperform the S&P 500 with stocks that are outperforming the S&P 500. I think getting into stock like Lyft prematurely is, you know, going to make it more difficult to outperform the S&P. So I would stick with the leaders and stay away from stocks like Lyft at this point. Now, if we can get back up, take out that recent high, get above the 50-day moving average, we already got the accumulation distribution starting to improve. So that's at least one positive. But I've got to see some relative strength improvement. We're just not seeing that yet. Coming up, earnings tomorrow, I was going to pull up Applied Materials. This is a report that I expect to be pretty good. It had definitely taken its lumps back in March and April relative to the semiconductor group, but it has been strengthening and just recently moved to about a 6-month high relative to its semiconductor peers, and it's been performing pretty well relative to the S&P. Semiconductors broke out again today to a new high. So all of that leads me to think Applied Materials probably going to come out with a better report, but it is up against some serious overhead resistance, the February highs. So can we get through? If we do, that would be great news. If not, watch for that rising 20-day moving average to provide some support. What else do we have tomorrow? NetEase reports tomorrow. So you got NetEase in that internet space. NetEase has been one of the leaders in the internet group, been sideways consolidating as we've been as NetEase has been consolidating. We've seen the relative strength deteriorate a little bit. That's normal. The stock had a big move. When you consolidate, a lot of the other groups or a lot of the other stocks in your group will keep moving higher. And so you underperform while you consolidate. That's normal. I think this stock's going to break out. I think right now it's in a range 440 to 500. Let's see which way breaks first. My bet is it breaks to the upside. Other companies reporting, won't take a look at them here, but Baidu reports. Farfetch, actually, let's pull up Farfetch. This is one that was doing extremely well, FTCH. Yeah, this stock, I would expect a big report. Accumulation distribution strong. The stock is way above where we were in January, February. In fact, as this stock was going down in March and April, look at its AD line breaking out. This stock, I'm sure, is on our strong AD list because of that. Strong AD chart list. But here's your relative strength. Check this out. Farfetch versus the Internet Group, absolutely a major leader versus the S&P 500. It's crushing it. And the group has been pretty strong, even though it's consolidated recently. So I think Farfetch looks good. I'll be surprised if they miss on revenues or earnings. I think you're going to see a beat top line and bottom line. Wouldn't even be surprised if they raise guidance, but then we'll have to see what kind of market reaction we get. Doesn't always translate into a strong market reaction. All right, let's go ahead and wrap the show up with the three you must see. I'm going to start off with Hologic. Hologic gapped up with its earnings recently. I like this stock a lot, but after moving straight up for a period of time, accumulation distribution strong, relative strength, everything looks good. It's one of the best medical supplies companies out there. At least that's what Wall Street thinks, and I'm going to agree with Wall Street. But look at the signal it gave on this pullback. Down, 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 hammer on the 20-day, and the intraday came all the way back down almost to test this gap support level before reversing, and then today we're stronger. I think now we have set our boundaries on Hologic's top and bottom, so that's what I would be looking for. I think the stock has a chance to get back up to 73, but watch maybe about 63 to the downside. Next stock up is KLA 10 Core. KLA 10 Core in the same space as Applied Materials. Applied Materials reports tomorrow. KLA breaks out today. I think this is a good sign for Applied Materials to see stocks breaking out in its space before they report earnings. So KLA, I like the stock. I think to the downside, you've got maybe the 50-day to watch, but otherwise I look for it to go higher. Last stock on this for today, I'm going to go over is AIG. And this is one that's on the flip side. Personally, I would avoid AIG. Check out the AD line. No strength whatsoever. Even when the stock's going up, AD line continues to go down. Failure, triple top here, and then look at the relative strength, rolling over versus its peer group and continuing to decline relative to the S&P 500 and its peer group declining versus the S&P 500. Don't worry about these stocks until they begin to show leadership qualities and characteristics. AIG is nowhere near that. That's it for me for today. Everybody have a great Thursday. Let's see what the market does, and then we'll go from there. I'll be back Monday at Earnings Beats with your next Trading Places Live. Have a great Thursday, Friday, weekend, and see you next week. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.